In 1929, a man named Jesse Livermore made $100 million in a single day. One day, while the entire world watched their savings evaporate into thin air, while grown men cried on the streets of New York, while families lost everything they had ever worked for. This one man walked away richer than most people could ever dream. And here is the crazy part. He did not get lucky. He knew something. Something about gold and silver that most people still do not understand today. And what I am about to tell you in the next 12 minutes could literally change the way you think about money forever. Now, before we dive into this, if you are someone who wants to actually understand how money works, not the boring textbook stuff, but the real strategies that wealthy people use to protect and grow their wealth, then you need to hit that subscribe button right now and tap that notification bell. Because every single week, I break down financial concepts in a way that actually makes sense, in a way that you can use immediately. Trust me, you do not want to miss what is coming on this channel. All right, now let me tell you something that most financial advisors will never admit. The game has changed. Completely. See, for decades, the standard advice was simple. Put your money in the stock market. Buy index funds. Wait 40 years. Retire happy. And look, that worked for a long time. But here is the problem. We are living in a different world now, a world where inflation is eating away at your savings faster than ever before, a world where the dollar in your pocket today will buy you half of what it bought 10 years ago, a world where governments are printing money like there is no tomorrow. And if you do not have a strategy to protect yourself, you are going to get left behind. That is not fear-mongering. That is just reality. And this is exactly why people are flooding into gold and silver right now. But here is where it gets interesting. Most people do it wrong. They hear that gold is a safe investment. They panic, buy some coins online, they shove them in a drawer somewhere, and then they wonder why their investment is not performing the way they expected. See, investing in precious metals is not as simple as just buying shiny objects and hoping for the best. There are specific strategies, specific approaches that can make the difference between mediocre returns and absolutely crushing it. And today, I'm going to walk you through 3 powerful ways to invest in gold and silver that most people have never even considered. And the third one is the one that completely changed my perspective on this whole game. But first, let me give you some context, because understanding the why behind precious metals is just as important as the how. See, gold and silver are not just pretty metals that people like to look at. They are ancient forms of money. We are talking 5,000 years of history here. Every major civilization, from the Egyptians to the Romans to the Chinese dynasties, used gold and silver as currency. And there is a reason for that. These metals have properties that make them perfect for storing value. They do not corrode, they do not rust, they are rare, they are difficult to counterfeit, and most importantly, you cannot just print more of them. Unlike paper money, which governments can create out of thin air whenever they feel like it, gold and silver are finite. There is only so much of it on this planet, and that scarcity is what gives them their power. Now here's where the story gets really interesting. Let me take you back to 1971. This was a pivotal year. A year that changed everything about our financial system. See, before 1971, the United States dollar was backed by gold. That meant for every dollar in circulation, there was actual gold sitting in a vault somewhere. It was not just paper with a promise, it was real, tangible wealth. But then something happened. President Richard Nixon did something that nobody expected. He took the United States off the gold standard, just like that, overnight. And suddenly, the dollar was backed by nothing but faith. Faith in the government, faith in the system, faith that somehow everything would be okay. And for a while, it seemed like it was okay. The economy kept growing. People kept spending. Life went on. But here is what they do not tell you. Since 1971, the dollar has lost over 96% of its purchasing power. Let that sink in for a moment. 96%. That means the dollar your grandfather earned in 1971 is worth about 4 cents today. 4 cents. Meanwhile, gold that was worth $35 an ounce in 1971 is now worth over $2,000 an ounce. That is not a coincidence. That is gold doing exactly what it is supposed to do, preserving wealth while paper money falls apart. Okay, so now you understand why precious metals matter. Now let me show you how to actually invest in them. And I'm going to start with the most obvious way first, but stick with me because there are some things about this approach that might surprise you. The first way to invest in gold and silver is by owning physical metal, actual coins. Actual bars, real, tangible, hold it in your hands metal. And there is something incredibly powerful about this approach. When you own physical gold or silver, you own it outright. There is no counterparty risk, no bank that can fail, no brokerage that can freeze your account, no government that can deny you access. It is yours, period. And in a world where everything is becoming digital, where your bank balance is just a number on a screen, there is something reassuring about knowing you have real wealth that you can physically touch. But here is where most people mess up. They buy the wrong products. See, not all gold and silver is created equal. When you are buying physical metal, you need to pay attention to something called the premium. The premium is the amount you pay above the actual metal value. And if you are not careful, you can end up paying way too much. Let me give you an example. Say the spot price of silver is $25 an ounce. If you buy a fancy collectible coin with beautiful artwork and limited mintage, you might pay $50 or $60 for that coin. That means you are paying a 100% premium. That is insane. For your investment to just break even, the silver price would have to double. That is not investing, that is collecting. And there is a big difference. If you want to invest in physical metal, you want to look for products with low premiums. Government-issued bullion coins like American Eagles or Canadian Maple Leafs are solid choices. Generic rounds and bars from reputable mints often have even lower premiums. The goal is to get as close to the spot price as possible so that when the metal price goes up, you actually benefit from that increase. Now, there is another consideration with physical metal that people often overlook. Storage. Where are you going to keep this stuff? A home safe might work for a small amount, but as your stack grows, you need to think about security. You also need to think about insurance, and you need to think about liquidity. How quickly can you turn that metal back into cash if you need to? These are not deal breakers, but they are things you need to plan for. All right, so that is the first way. But here is where things start to get really interesting, because the second way to invest in precious metals solves a lot of those problems, and it opens up possibilities that physical metal simply cannot provide. The second way is through exchange-traded funds, commonly known as ETFs. Now, I know what some of you are thinking. ETFs? That sounds boring. That sounds too mainstream. But hear me out, because this approach has some serious advantages that you might not have considered. An ETF is essentially a fund that trades on the stock market just like a regular stock. But instead of representing ownership in a company, a precious metals ETF represents ownership in actual gold or silver. The fund holds the physical metal in vaults, and when you buy shares of the ETF, you are buying a proportional claim to that metal. Some of the most popular gold ETFs hold billions of dollars worth of gold bars in secure facilities around the world. And when you buy shares, you become a fractional owner of that gold. Now, here's why this is powerful. First, liquidity. You can buy and sell ETF shares in seconds. You do not need to find a buyer. You do not need to ship anything. You do not need to verify authenticity. You just click a button and the transaction is done. Second, storage and security are handled for you. The fund takes care of all of that. You do not need to worry about safes or insurance or any of that stuff. Third, you can invest any amount you want. With physical metal, there are minimum purchase amounts and shipping costs that make small investments impractical. With ETFs, you can invest $100 or $100,000 with equal ease. But here is the catch, and this is important. When you own an ETF, you do not actually own physical metal. You own shares in a fund that owns the metal. There is a difference. If something catastrophic happens to the financial system, if there is a major crisis, your ability to access that metal could be compromised. The fund could be frozen. The exchange could shut down. Your brokerage could fail. These are unlikely scenarios, but they are possible. And for some people, that counterparty risk is a deal breaker. There's also another consideration. Some ETFs do not actually hold the metal they claim to represent. They use complicated financial instruments called derivatives to simulate the price movement of gold or silver. These are called synthetic ETFs, and they carry additional risks. If you go the ETF route, make sure you are buying a physically backed ETF that actually holds real metal in a vault somewhere. Read the fine print. Understand what you are buying. You are. Okay, so we have covered physical metal and ETFs. Two solid approaches with their own strengths and weaknesses. But now I want to share the third way, and this is the one that really opened my eyes. This is the one that can potentially deliver returns that physical metal and ETFs simply cannot match. But it also comes with risks that you need to understand. The third way to invest in precious metals is through mining stocks. And before you click away, let me explain why this is so powerful. When you buy a mining stock, you are not buying gold or silver. You are buying a piece of a company that finds and produces gold and silver. And here is where the leverage comes in. See, a mining company has fixed costs. They have to pay for equipment. They have to pay workers. They have to pay for energy and processing. Those costs stay relatively constant regardless of what the gold price is doing. So when the gold price goes up, their costs stay the same, but their revenue increases. That means their profit margins expand dramatically. A 10% increase in the gold price might translate to a 50 or even 100% increase in the mining company's profits. And as profits go up, so does the stock price. Let me give you a real-world example to illustrate this. Say a mining company can produce gold for a cost of $1,500 per ounce. If gold is selling at $2,000 per ounce, they make $500 profit on every ounce they produce. Now imagine gold goes up just 20% to $2,400 per ounce. Their costs are still $1,500, but now they are making $900 per ounce in profit. That is an 80% increase in their profit margin from just a 20% increase in the gold price. And that leverage works the same way for silver miners. This is why during precious metals, bull markets, mining stocks often outperform the metals themselves by a factor of 3 or 4 or even more. During the gold bull market from 2000 to 2011, while gold went up roughly 600%, some mining stocks went up 2,000% or more. That is life-changing money. That is generational wealth territory. But here is the part you need to understand. This leverage cuts both ways. When gold or silver prices drop, mining stocks can get absolutely crushed. Those same profit margins that expand when prices rise will contract violently when prices fall. A mining company that is making $500 per ounce profit when gold is at $2,000 can suddenly be losing money if gold drops to $1,400. And when companies start losing money, their stock prices collapse. We are talking 50, 60, 70% drops in a matter of months. It is brutal. This is why stock selection matters so much with mining companies. Not all miners are created equal. You want companies with low production costs. You want companies with strong balance sheets and manageable debt. You want companies with proven reserves and experienced management teams. You want companies operating in politically stable jurisdictions where the government is not going to suddenly nationalize the mine or change the tax laws overnight. Doing your research here is absolutely critical. And here is another factor that makes mining stocks interesting. Discovery potential. See, when a company discovers a major new gold or silver deposit, the stock can explode almost overnight. We are talking 10, 20, even 50 times your money in some cases. These are called junior exploration companies, and they are essentially lottery tickets in the mining world. Most of them will fail. Their exploration will come up empty. They will run out of money, and your investment will go to zero. But the few that hit a major discovery can deliver returns that seem almost impossible. Now let me bring all of this together and share something important about strategy, because knowing these three methods is only half the battle. Knowing how to use them together is where the real power lies. Most successful precious metals investors do not choose just one approach. They use a combination based on their goals and risk tolerance. Think of it as a portfolio within a portfolio. Physical metal serves as your foundation, your insurance policy, the metal you hold for true emergencies, the metal that would still have value even if the entire financial system collapsed. You do not worry about short-term price fluctuations with this portion. You are holding it for the long haul. ETFs serve as your tactical allocation, the portion of your precious metals investment that you can easily adjust based on market conditions. If you think gold is about to make a big move, you can quickly increase your position. If you think a correction is coming, you can easily sell and wait for better prices. The flexibility here is the advantage. And mining stocks serve as your speculative allocation, the portion where you are swinging for the fences, looking for those outsized returns that can truly move the needle on your overall wealth. But you size this position appropriately because you know it can go against you just as quickly. The specific percentages will depend on your individual situation, your age, your financial goals, your risk tolerance, your overall portfolio. But understanding how these three pieces fit together is essential for building a robust precious metal strategy. Now let me leave you with one final thought, something that ties everything together and explains why I think this information is so important right now. We are living through one of the most significant monetary experiments in human history. Governments around the world have printed trillions of dollars over the past few years. Interest rates were held at zero for over a decade. Debt levels have reached heights that would have seemed impossible just 20 years ago, and the consequences of all of this are only beginning to unfold. Nobody knows exactly what happens next. Nobody has a crystal ball. But if history teaches us anything, it is that when currencies are debased, when governments spend beyond their means, when debt spirals out of control, precious metals tend to shine. Not because of speculation, not because of hype, but because gold and silver have proven themselves over thousands of years as reliable stores of value in uncertain times. And we are definitely living in uncertain times. So here is what I want you to do. I want you to take action. Not tomorrow, not next week, today. Start educating yourself, start researching, start building your plan. Whether you choose physical metal, ETFs, mining stocks, or some combination of all three, the important thing is that you start. Because the worst thing you can do right now is nothing. The worst thing you can do is watch your purchasing power erode while hoping someone else will fix the problem for you. Now I have a question for you, and I genuinely want to hear your answer in the comments. Which of these three approaches resonates with you the most? Physical metal, ETFs, or mining stocks? And why? Drop your answer below because I read every single comment and I love hearing your perspectives. Your experience might help someone else who is just starting their precious metals journey. And if you know someone who has been thinking about investing in gold or silver but does not know where to start, Send them this video. Seriously. Share it with a friend or family member who needs to hear this information. Because in a world where financial literacy is so rare, sharing knowledge like this can genuinely change someone's life. Finally, if you have not already, make sure you subscribe and hit that notification bell, because this is just the beginning. I have so much more content coming that will help you navigate these crazy economic times and build real, lasting wealth. Do not miss it. Until next time, stay curious, stay informed, and keep building your financial future. I will see you in the next one.